So typically, Jason Lee and Jason Jimenez take the next two slides, but just want to thank our speakers. Thank our sponsors for this particular year. And as we're moving into 2026, we're going to be retooling the sponsorships even more just to make sure that our sponsors, as well as our members, are able to get more out of what M&A Forum what they can achieve here at M&A Forum. With that said, what we typically do during the program is give one of our sponsors a 5-minute highlight, one of our platinum sponsors. Today it's going to be George Kariski with Johnson DeLuca Kariski and Gold. George.
It doesn't seem not to be but the old saying, worship, right? Well, so now you've heard tours. That's enough. Course come this be talking get by profound pleasure that say Gary part is say on I'm all from the no said about that. The rare ball been May Street to Wall Free to 6 figures to Brian Baker, but right back. One of the most important things about M&A Forum in Ballet is how all Burke leadership a forward perspective. I had the great good fortune to know both of you and work with or for vast majority of those. Those of my I don't know I didn't be if I do Mr. for in any business support professional boy. I use my info I have to talk. This group is important to me to support the editor or little friend one is the ability to help you with rural mission will be just don't answer. Oh, and it's so risky. I love that's the way the or relatively you do the night at the day. Cooking it.
Again, memberships, for any of you that are here today, that are drop-ins that have just been visiting us on an ongoing basis without becoming a member, take a look around, and obviously we're moving into a much larger space. This is the place to be in order for you to get the most out of your membership. So, consider becoming a member. Speak to Jason Jimenez. He's our membership chair. If you'd like to know more information about exactly what you can gain from a membership with M&A Forum.
Okay. I would have the list do that. She had to wrote out open. So July 22nd, we have Jerry Jensen with Penang Research Solutions. The TV Venture. August 26th. Oh, by the way, we will be at a new venue there. So that's a new venue starting July 22nd with SVDC. So look for us there. There's a lot more room for us to spread out and have a seat. August 26th, Chad Callan with Beachview Vacation Rio. September 2nd in our social mixer. And Melissa, do you want to tell us a little bit more about that, or you want me to go for you?
Hi. I do top now, yes. Yeah, so we have our social mixer coming up. Thank you. On this screen anymore.
So we've got a social mixer coming up that was finalized yesterday. I am so excited. So we're going to head over to Escalante's down in River Oaks from 4 to 6 on September 10th.
Okay, there you go.
Sorry, guys, it's been a day. I don't even have any jewelry on. So anyway, really hope to see you guys there. I know Noise will put that online so you guys can all register. As you know, it's stuff kind of sells up fast. So hope to see as many registrations as we can. Thanks, guys.
All right. Yeah. Can we go back to one slide, please? If everyone can just make a quick note of our venue change moving forward. 2025 and 2026, obviously, we've outgrown this space. We can now move into a space where we can host about 90 plus people, or up to 90 people. It's going to be at SBDCO. It's not here. It's going to be a small business development center. You're going to get the address in all the upcoming events. So I just want to give you a heads up on that. All right, let's move to next slide. So last month, I asked everyone in the audience, what does change look like in business? How do you define change in business? And someone happened to raise their hand and said, M&A, of course, that's why we're here anyways. And the reason why I asked that is it's how you respond to that change. So in an acquisition environment, once you've acquired that business, what do you do with it? Well, I happened to hear and be in the audience for when Rob was speaking at another event. And he said something that really stood out to me. He said, we're not financial engineers, we're business builders. We don't strive to be financial engineers. We want to be able to buy, or we want to be able to build a business that we would want to one day buy. So why not do that? And then one last question that really stood out to me is, what do we want to be as a company when we grow up? And that was kind of that question that left me thinking for a while. Like, you know what? I got to have Rob come in and speak to our audience and share his story here. So Rob with Shorehill Capital, if you can join us at the front, please.
Thank you. Is my mic on, I presume?
Let's take a look. Okay. Test that out.
Can you hear me? I presume you can.
Yeah.
Excellent. Well, thank you.
Well, Rob, so let's do a quick intro and give us a little bit of a background on you and give us a little bit of background on you and Shorehill Capital.
Sure. So I'm one of the founders of Shorehill Capital. We formed Shorehill 12 years ago now, after I and my two other colleagues, my fellow founders, had spent a career at a much larger private equity firm in Chicago called Code Hennessy and Simmons, or CHS. And that business it raised 5 funds starting in 1989. Its most recent fund before we left was $1.3 billion, and that was in 2005. So as you can imagine, we were focusing on buying much bigger businesses.
Yeah.
And this gets to the point you made earlier about financial engineering. That was financial engineering. We came up with creative structures to finance those transactions, and at the end of the day, it was somewhat like stock picking, where you would select a management team and let them go do their thing. We decided we were done with that. Myself and my two other colleagues, we decided we'd form Shorehill Capital and really do lower middle market industrial investing. And when we stepped back and identified how we wanted to do that, we recognized this theme of being a business builder rather than a financial engineer. We wanted to work with small businesses that were, maybe they weren't A companies in the true sense of the word, but they were oftentimes founder-owned companies that had great relationships with customers, but didn't have, standard operating procedures, a monthly financial statement, or anything to speak of with regard to structure or metrics. And so we went into the initiative of forming Shorehill Capital to do just that, to help firms, professionalize and take them through a process of upgrading their people, their processes, and their technology. But starting with alignment, that's a topic we might address earlier or later, but starting with alignment and then driving real value creation from a business building standpoint. If you think about, our business, it's clearly lower middle market. We sign probably 700 NDAs a year and maybe close 5 companies a year. So it's a horrible batting average, but we've been pretty successful at the 5 companies we bought each year. So first fund we raised back in 2014 was $190 million. and 80 million of it came from myself and our other founders. Very successful investment portfolio there. Ultimately raised our second fund in 2023. That's the one we're investing in now. It's 260 million, with about 55 million of it coming from the founders. And really, that's a big driver of our success, is building relationships with intermediaries and with business owners, partly because we've got a lot of skin in the game.
Yeah, and of course, that obviously plays into how you're actually here.
Yeah.
And of course, being able to develop that level of trust with a prospective seller is a big component of that.
Absolutely.
Yeah. So why not share what the market looks like from your perspective, and how is Shorehill shifting at the moment, as well as how are some of the portcos that you guys are working with, how are they shifting with regards to many of the changes that are happening in the market right now?
Well, we thought 2025 was going to be a boring return to normal after the excitement of the last couple of years, and boy, were we wrong. But we just had our LP advisory committee meeting, so I have all the stats in the top of my head. In the first quarter, if you look at the broad lower middle market landscape, deal flow has been down anywhere from 25 to 50% in the first quarter versus first quarter of 24. Now, one of the caveats is the first quarter of 24 was very strong. So, the fact that we're down is not uncommon. If you look at Shorehill, I look at our deal flow in the context of the number of NDAs we sign. That means it's a deal we're interested in getting to dig a little deeper on. We're down like 24%. So we're pretty much down at the better end of the market, but still down. And I would say from the number of indications of interest and LOIs we've signed, it's certainly down more than that. So what are we doing about it? I was the one and only business development person at our firm. After I'd spent a number of years in managing investments for us and have started to transition to fundraising and business development, I was the only one for a while. And if you think about those 700 deals that we sign, or NDAs we signed, it's from 350 different intermediaries. So the landscape of intermediaries is dramatically different from when we had $1 billion fund. When we had $1 billion fund, our deal flow would come from about 40 different intermediaries. You go down market, it's hundreds. Yeah. So to be able to cover that market well, we've added a business development resource. And then the other thing we've done is to try to find alternative sources of deal flow. Our executive advisor network, asking them to target opportunities for us. Wealth advisors, accountants, trust and estates attorneys, you name it. Those are segments that we just haven't addressed in the past, or appropriately addressed in the past, and we're pursuing those folks as well now.
Got it. So what does a good target company look like for you?
So good target company for us is typically a privately owned business that has incredible relationships with customers and maybe doesn't have the structure that we would look for, again, down the road, or what we would help build. That business typically has complex relationship with customers. That's always a big key for us. Is we're not looking to buy businesses that break bulk and just sell from one company to another. It's really what's the true weekly or sometimes daily relationship you have with that customer. They're businesses that are critical components or services, and that could really benefit, and this is the most important part of it really for us, is that could benefit from us as a differentiated buyer. Can we help them take their business to the next level? And when we think about it that way, then we're looking at trying to understand, do we have experience in that space? Do we have executive advisors who have experience in that space? And if we don't, then it's probably something we'll look to move on from. One of the most important things that we're focusing on these days is the industry they operate in, and that's of course always a theme for us. But more importantly today, it's understanding the private equity activity level in that space.
Right.
My brethren in private equity are lemmings. We follow each other everywhere we go. If someone's successful in a landscaping investment, then you're going to see 500 landscaping investments from private equity. So we actually spend a lot of time looking at those segments, and if there's too much private equity activity in the space, we'll move on. And that list of spaces is growing. If you think about HVAC services and
Exactly. That
plumbing,
typically where a lot of capital is heading in that
Yes.
direction, right?
yeah. So we'll zig when others zag.
Yeah.
I think I was telling you the story about how one of our deal leads, I'm on the investment committee, and one of our deal leads brought us a deal to review that was in one of those spaces, like plumbing or landscaping, something. And my one question to him was, why do we want to be the 41st private equity backed platform in the space? Like, why would we do that? Right. And he didn't really have an answer.
Yeah.
So that's the kind of thinking we're going about right now. It's not just, what's the size of the market? What are the growth opportunities in that market? What's the competitive profile? It's really how much is private equity active in this space?
And I don't think we touched on this yet, but what's a typical hold time for a company?
So for us, it's a little longer than what you might hear. We are not the quick flippers that you see in private equity. And part of that is, you have a lot of your own money invested in a business, and you understand that business and you understand how to drive value creation in that business. Why sell it based on some artificial deadline? So I in many instances think of Shorehill as a little bit of a hybrid between a family office that holds businesses forever and a typical private equity firm that owns a business for 2 to 5 years. So, and I think our style is particularly relevant in the lower middle market because you're dealing with businesses that are not going to be able to flip the switch on professionalizing themselves over 2 years. It's going to be a process. And I've heard other folks talk about 100-day plans and those sorts of things. And I oftentimes think that within 100 days, I want to be able to get from the airport to the company without looking at Google Maps. That's my plan for 100 days. It's not about, doing this, crazy amount of change that really changes the company's characteristics. And we want to honor the founder's legacy. So wiping that out in 100 days is really, I think, just shooting yourself in the foot.
Yeah, that's a dramatic overhaul.
Yeah.
And so, that's a great segue to go into, 80% of your founders tend to be, or 80% of the businesses that you buy tend to be founder-led.
Mm-hmm.
So how do you convey to the founder that you're the right buyer and that, again, their business is something that you want to continue to honor their legacy while you can actually build it into something greater?
Yeah, part of it is describing what I've just described to you, where we're not the typical private equity fund where we're in and out in 2 to 5 years, and we're not the forever hold of a family office. So we're somewhere in between. So we're going to be patient capital. But the number one way in which we convince someone to work with us is trust. It's we're all pretty genuine Midwest folks, if that's a thing you can say in Texas. So it's building trust not only as people, and that we're good, ethical, virtuous folks, but also trust that we can be the right kind of buyer for them. So, do they trust us to understand the situation they're in?
Right.
We've got a business under LOI now that horrible accounting, worst I've seen, needs an ERP conversion, doesn't have a CRM system, but we've dealt with all of that. We've dealt with it before. And because we're patient capital and we can hold it a little bit longer, we can manage through that. So that's kind of a elongated way of answering your question, but the trust is the most important thing. And then I think the second piece of it, which I think is really critical, is recognizing the business leadership's success in what they've built to date and building on it, as opposed to ignoring it and throwing it away. So it's honoring the past in how I like to think about it. So we do it in many different little ways. We have a we have a Founders Day at almost all of our portfolio companies. So one day a year, it usually works if it's a one location firm, but in situations where it's multiple branches, we'll do something where on one day we'll bring in some food trucks and maybe a dunk tank or whatever it is, but then invite the founder or the founder's family back to honor them for what they built. It's a really simple thing to do. Creates incredible bona fides with the founders as well as the rest of the folks at the company. And so that's just one example. There's many others, but it's trying to make the connection to the past while you're building something in the future.
That is something for all of us to kind of take away from all this, right?
Founders Day.
Yes, Founders Day. So before you actually complete that transaction, of course, there's negotiations happening and a lot of back and forth. What have you seen? What makes things go right? What makes things fall apart?
Open and frequent communication, I think, is probably what makes things go right, even when it's not what they like to hear. We've all been through long, painful diligence processes, and open, frank conversations about where we are and what we have to do to get done, and really have not hide anything, either us or the sellers in that respect. Really hide the ball and spend the time trying to find it. It's really going to create all sorts of issues. So we many years ago we hired a marketing firm to understand what makes us different, and one of the incredibly boring but compelling pieces of feedback is that we're really straightforward in how we communicate. And it's not like we're straightforward, but at the end of the day, you're never going to guess what we're thinking or where we're going, and you're never going to be surprised by some feedback.
No ambiguity.
Yeah, and I think that sometimes can be interesting at the outset, but I think when we all get to know each other, that's the best way to operate, in my opinion. So if you don't have that early on, I think any sort of transaction is going to struggle.
Absolutely. And again, kind of going back to the whole falling apart and things going right, time also tends to be a big component of that. I'm a big believer of everything in business has a shelf life.
Yeah.
Right? However, urgency has also gotten the best of me, and then it's always great to have people, and particularly leaders around you, that tend to say, okay, well, pump the brakes real quick. Let's figure out all the ins and outs of this before you jump the gun here, and you're finding out that many of the pieces have gotten missed along the way. What have you found in many of your deals where time has been on your side versus there's been an over deliberation to the point where you said, what, either the sell side has been has allowed for the deal to go stale, or the buy side has allowed for the deal to go stale?
So it's a good question. Difficult to answer, partly because you're threading a needle. I think early on, I'm somewhat reluctant to push a transaction too quickly. It's almost like I kind of want it to percolate a little bit with the business owner. So in many of those first couple meetings with the business owner, it might just be getting to know them and not really talking about a transaction. Because if you switch to flip the switch too quickly into transaction mode, it might turn them off. I worked on a meaningful add-on for one of the portfolio companies that I oversaw, and 6 years it took me to get from the first time I met him till when we closed the transaction. And at the closing event, he told me that he knew he was going to sell the business to me 6 years ago. Like, okay, well, that would have been nice to know a long time ago. And at the same time at my firm, there was one of my partners got a deal closed where he met the guy like on a Saturday and signed an LOI on the next Friday or something. It was, made me look really bad. But the point is that, I didn't push him too hard, because he would have he would have kind of pulled back. He would have thought I was a slick private equity guy. So it's about reading the room and understanding where to push and where not to. But once you're into a transaction and you got an LOI signed, obviously we all know time is of the essence.
Yeah.
Over deliberation, particularly on the part of the private equity firm, probably means that you've chosen the wrong partner. I hear way too many instances today of private equity firms engaging in 6 months worth of diligence. And just like for small businesses, why do you keep giving them exclusivity? They're just waiting for something to go wrong in your business so they can point to it and say, "Ha ha." Just not where we are. So it's a threading a needle, and it's the fine line between letting a deal percolate and kind of you snooze, you lose. And I've had that happen. Where I waited a little too long to give a business owner a little bit of time to think, and someone else swooped in, gave him an offer without any information, and the guy jumped at it.
Oh, wow. Wow. Well, let's think about it when you're entering into that transaction mode. How do you look to drive home the theme of partnership as it relates to equity rollover?
Equity. Yeah, sure. So this is one where we spend a lot of time on this. So, there's rollover, and then there's maybe if the management team doesn't have any equity, what they're going to be able to put into the business post-closing. So our expectation is that every business owner will roll over some amount into the new deal. We want to be, true partners in that respect. So depends on the level of role that owner is going to play in the new transaction. Will drive whether they're putting in 50% of their proceeds or 20% of their proceeds. But where we spend a lot of time is in the management team and their ability to invest in the business, because we want as many people walking in the door of our companies acting like owners as possible. Now, there's a limit. I think I was just talking with someone recently where at some point that person working the line in the warehouse, they're focused on current comp, and giving them equity doesn't really mean much to them. So in many instances, we will have somewhere between 10 and 25% of our employees be equity investors, where they write a check. What we'll do is not just say, "Okay, you're an equity investor, go act like an owner." It's frequent and ongoing communication about what it means to be an owner, and education about what it means to be an owner. So anyone who's done an LBO before knows there's only 3 ways to create value in a business. It's pay down debt, increase earnings, or increase the multiple in which the company's worth. And that's it. If there's another one, let me know. But we have once a year, sometimes twice a year, we'll get all the management shareholders together in a room, and we'll talk about how the company's doing. And we'll talk about how everybody in the room, whether you're in the finance department or you're in sales or you're the CEO, has the ability to create value. And we walk through, again, those kind of 3 themes of pay down debt, increase earnings, or increase the multiple. And what is it? They all look at me and say, "Well, how do I increase the multiple of the business?" And that's through the professionalization process. But it's through that education. And it's always one of my favorite meetings of the year, because you can see in the crowd in front of you, like their minds turn, like, "Oh, well, so I can do something that can create value." And then at the end of that meeting, we will give them an envelope or send them an email, which is an estimate of what their equity is worth. And it's an estimate. It's not perfect, but it's our best guess as to what the equity is worth. And talk about a good retention program, a good program for keeping people engaged and excited when they see things going in the right direction. And they'll also see things going in the wrong direction and speak up and say, "Why are we doing that? Why are we spending money on that?"
When they have skin in the game,
Yeah.
obviously they're way more entwined or in tune with what actions and what decisions should be made versus when they don't have that skin in the game, right?
Yeah.
They're just completely hands off.
So one of my favorite stories is, again, one of our portfolio companies where we invited a woman who ran our inside sales for one of our portfolio companies to to invest. And single mother called me and kind of told me, she's like, I can't invest very much. I mean, I just don't have a lot of money. And I said, well, what are you thinking? Like, what could you invest in terms of cash? And she said, maybe $5,000. So I said, for people like you, we want you to be an investor. So what we'll do is we'll match your investment dollar for dollar with a low interest loan from the company. And, interest will be due on the day you get your bonus every year. So it's just a netting out of bonus versus interest, and no principal due until 10 years from now. So her $5,000 became $10,000. Her $10,000 investment became $100,000 when we sold the business. It was 10 times our money. She obviously paid off her little $5,000 loan, and she, was home free with $95,000. She earned it. So in almost every instance where we did an add-on, she was the person who went in and trained the inside salespeople at that company to how to work under our system. So it wasn't like we just kind of, out of the goodness of our hearts, gave her, $100,000. She earned it, and as a result, was able to be the beneficiary of the value she created.
Wow. Let's take a few steps back. Once that transaction is complete, one of that question, your signature question of what do we want to be as a company when we grow up? When I thought about that, is like, well, he's not buying a company that's in its infancy. Of course, the company has grown up to a certain extent, but I would probably think about it as, okay, well, you're buying it at an adolescent stage. I think they've got everything figured out, but there's there's a whole host of sort of discrepancies, and probably a lot more maturation that needs to occur in that particular company. So what does the adolescent stage look like for that particular company once you've acquired it?
It's a little bit of what I said before, where in many respects, their business is run by intuition. It's where the business owner can look at their checking account or walk the warehouse floor and understand what's going on. But that doesn't work when you have 12 warehouses.
Yeah.
Right. And you're a much bigger business. So we're seeing those businesses where it's run by intuition. There's, like I said, no standard operating procedures, no safety program, no standard process by which you look to hire a salesperson. Like, what are you looking for? It's just one of the lead salesperson's buddies. There's no process to it. So we'll use everything from, put in place more metrics around tracking of initiatives, but really it starts with, and this is where the alignment theme comes in. It starts with alignment, but we're looking at businesses that are, like I said, they're solid businesses. They're just not ready to run yet.
They lack the visibility.
Yeah, they lack that visibility. They lack what I would call sort of the foundation from which to grow. And I think a lot of my private equity brethren don't really focus on the people, the processes, and the technology. They just go, let's do the next add-on, let's open the next branch, without thinking about, well, are we ready? Can we absorb that add-on or not? Or do we know how to open a branch? How does that work? So a lot of times I think about it in the context of building playbooks on how to do things, how to hire the right salesperson, how to open a branch, how to do an add-on.
Exactly. Just having that sort of a consistent repeatability in the ability, in that entire system. So let's think about alignment. And, you said that, of course, the first 100 days aren't necessarily something that you play to, but can we expand that out to 12 months? What do the first 12 months look like?
Yeah. So my facetious joke about finding my way to the company, one of the things we will do in probably the first 100 days, or at least the first 6 months, we'll actually do two things. One is a strategy session with the leadership team. And that leadership team would be probably the CEO and their direct reports, and maybe one other level. And in that strategy, it'd be a one-day strategy session, and everybody will have homework to do in advance. And the homework is for each person individually, without, showing each other, what are the 5 biggest risks the company is facing today? What are the 5 biggest opportunities the company is facing today? And what should the company's priorities be? And if you have 10 people in the room, when you write those down, you might have 50 different things. And so the intent of that strategy session is to align everybody on the same key topics, and that includes us. So it's not us driving, the show, but we're in the room and can add value to that discussion. But it's really meant to get everybody on the same page, to talk about the same initiatives, and to come out of there with really what we call the fundamental 5. And maybe it's 4, maybe it's 6, but we don't have a good name for the rest of it. But it's really 5 key initiatives that the company is going to pursue over the next year, which oftentimes will be driven by the theme I said about foundation, building the foundation from which to grow. And then that will be all we talk about. We don't talk about, if it's not in the fundamental 5, we don't talk about it. And that's really a key part of it. And then the other thing we'll do is an employee engagement survey. I don't know whether folks have done that before, but it's a survey that just tells you how engaged your employees are with you as a business and how interested they are. And that's really eye-opening. You get a lot of understanding of, in private businesses, a lot of times communication wasn't great with the employees, but we can find ways to change that. We also look for, hey, what do you recommend we do? What are some issues? There's almost like an open spot on the survey where it says, just tell me something that's a problem and we can fix it. And I know there was one of our portfolio companies down in Indianapolis. One of the respondents said, when I get off of work at 6 o'clock in the wintertime in Indianapolis, it's dark in the parking lot, and my car's in the back end of the parking lot, and I don't like walking out of there in the dark. It makes me nervous. So for, I think, $3,000, we put lights up in the parking lot. And that person told everybody they knew that they put it in the survey, and then we did it. So it was kind of one of those where, okay, so
they actually care about
big, bad, scary private equity. Well, maybe they actually aren't as bad as we thought. Really, it was a small victory, as people say, get a small victory early. Well, that was one of them. And then we do a benchmarking survey every year thereafter to see how we're doing from an employee standpoint. So those are the 2 big pieces at the outset: drive alignment, and then get a sense of where the people are in the organization, to start working towards where you want to be.
And there's that emerging theme. I mean, in order to get that employee buy-in, and continue to drive up that particular engagement, you certainly have to be able to invest in people. And I kept hearing people over and over again in your in your response here. So how are you investing in people beyond that and helping them develop? Because I think that was something also that stood out to me the last time I heard you speak.
So we do a lot early on about succession planning with our companies. So we'll do it's called a 9-boxer. I don't know if people have ever done that, where you look at performance versus potential, and basically starting to identify who your high performers are and your low performers are, and where you've got high performers, trying to find where we can keep them engaged and they're doing the business. But beyond that, it's putting people in Vistage groups or in YPOs, getting them for continuing education for different opportunities. One of the fallacies, and maybe this is more the financial engineering type private equity firm, but if we're business builders and we're trying to build business, is the last thing you want to do is cut people. You want to try to find opportunities for people to be in the right spots. So some of it is moving the right butts in the right seats. But beyond that, we're looking to try to, of course, make or work with folks to become investors. We're adding people to the board that are maybe an outside voice, and they're not us. So we'll have a lot of independent board members or executive advisors who serve on boards. just I'm sure I'm forgetting some of them, but it's a heavy people orientation,
Right.
with the knowledge that some folks maybe aren't going to develop to the point where we may have to move on from them, or in instances where the company had a bookkeeper. Well, now we're 15 million of EBITDA. They might still be a bookkeeper. They might have a role to play in the business. They're just not going to be the CFO.
Yeah. And there was a one specific story that I recall where you had an add-on, and there was I believe it was
yeah.
someone that was working as a kind of a marketing associate.
Yeah.
So, well, instead of just slashing that job, you were able to essentially find a position for them.
Yeah, it's a perfect example
Yeah.
of it. Is if you're a business builder, you need people and quality people. So it was our second add-on at Bell Power. It was a small business, but they had one individual who did all their marketing and really prepped every salesperson for every meeting they went out on, with whatever they needed. And when we go into that business and explain to them, along with the founder, that okay, the business has now been sold to Bell Power, which is private equity backed, of course everybody freaks out. But in many instances, it's actually more opportunity, not less, because we just, we had started with Bell Power, we added 2 add-ons, and we knew we were going to do a bunch more. We needed somebody who was a marketing specialist. And here's this guy that was a marketing specialist at one of our add-ons. So within 6 weeks, he was the director of marketing at Bell Power.
Wow.
And that's just an example of where you can, the old world of Wall Street the movie and cut, slash, and burn just isn't the situation in the lower end of the market where you're business building.
Yeah. Well, let's move into your, you talk about the back pocket network.
Oh, right. Yeah.
And how that drives value for many of your portcos. Tell us a little bit about that.
So this was back when we were forming Shorehill. One of the things we were being told is that we had to have operating partners. We had to hire former CEOs and put them on the payroll and help us oversee portfolio companies. We didn't like the idea, partly because you hire 1 or 2 of those folks. They cost a lot of money, and they don't fit in every deal you're ever going to find. And what are you going to do if you have them on staff? You're going to force fit them into whatever deal it is and say, oh, you're the perfect person for that. So, and we also recognize that my firm, my old firm, started in 1989. I started there in 2000. We have this long history of executives going back decades. So what we did is we created this Shorehill Executive Advisor Network. And at the time we started with, I think there were 30 executives. And they were folks that we had worked with in the past as our former CEOs or CFOs or directors of marketing, you name it. They were people that we had known really well. Like they were trusted friends. And we wanted to create this network that we describe it as being on call rather than on staff. And they can serve an incredibly broad role, from investment and talent referrals to due diligence support to serving on boards and being mentors and advisors on our boards for us. And that network has now grown to, I think it's about 65 executives, and they're all industrial folks. So, when we go to a business owner, and this kind of goes back to trust that not only that we're good people, but that we know what we're doing, is that we're coming to that business owner with our own experience and knowledge, but also the knowledge of this executive advisor network. As an example, we have one of our executive advisors who's a real specialist on B2B online marketing. And many of our businesses, they just have no idea what they're doing there. Well, if that business is particularly attuned to that opportunity of online sales, then maybe put that person on that board and help them play an important role going forward.
Yeah. Let's move into your preference for MOIC over IRR.
Mm.
Yeah. What drives that? And, again, how does that influence your decisions?
So we talked earlier about not wanting to be quick flippers. I think the quick flipper world is very focused on having an IRR that they can point to.
Yeah.
So, I love the press releases that private equity firms put out after they've owned a business for 2 years and they sell it. And they talk about the great IRR, or they put it out there about the great, 30% IRR they generated, which isn't even 2 times their money. And then they talk about all the things they did, which you can't do in 2 years. But our view is, and anybody who's got a lot of your own money invested is going to have this view, is that you want to create multiples on your invested capital over a period of years. And combine that with a lower middle market focus where it takes time to turn these businesses from, no accounting, no standard operating procedures to a business that's ready to run. That's going to take time. So having that focus on a longer hold really helps there. Second, when you have a longer hold perspective, you're much more comfortable pursuing organic growth. I see today in private equity almost a solitary focus on add-ons. That's the only way to grow.
Yeah.
And why is that? It's because they only plan to own it 2 or 3 years. So if you want to do a organic growth initiative that's going to take 2 or 3 years to germinate and really create value, it makes no sense to do organic pursuit or growth of organic nature. So that's our big focus, is that what we want to be able to do, and this goes to kind of building a business that somebody else wants to own, is to be able to tell that next owner that we can grow in a multitude of ways. We can pursue add-ons. We can hire salespeople. We can hire the right salespeople that work, that have like an 80% success rate. Or we can open branches. We can get into new channels. And why can we say that? Because we did it.
Right.
That's, I think, where you get the outsized growth.
And putting just more time and effort into that one particular company rather than just bloating it is what I'm hearing.
Yeah.
Right.
Yep. I think the market has recognized this over the last couple of years. Businesses and private equity firms that just slap deals together and get them out to the market they're failed auction processes, because buyers are now recognizing that any monkey can do an add-on, right?
Yeah.
It's what you do with it that is really important, and being able to, either buy the right businesses or do an organic pursuit of a new branch in a new location. That's what's going to get you the outsized multiple when you go to sell.
Agreed. Yeah, certainly. So if you had to distill Shorehill's philosophy down into a few sentences into one thought, well, what would that be?
It's that we are the right private equity partner for a business owner that's looking for someone to take care of their legacy, who has the patience to support the growth of their business through this stage from alignment to foundation building to hitting the gas on growth, and who is going to do it in a ethical way and find opportunities to support their management team and their people to optimize their performance and their returns.
Fantastic. Rob, thank you so much. I'm going to open this up to the audience for, let's see, we've got about 5 minutes for Q&As.
Oh, geez.
Jill.
Sorry.
Thank you.
Yeah, thank you. Good to meet you.
Great presentation, and I want to thank you very much for that. Very interesting. I would think going in as a PE firm into a business, so one of the biggest concerns would be how the employees are going to accept you. And you probably got the buy-in of the C-suite, upper management, and then you've got everyone else that thinks they're going to lose their job.
Mm-hmm.
And you did mention that there is an equity buy-in for a lot of the employees. How do you overcome that fear? Because when they start talking amongst themselves and that the world's coming to an end, got to alleviate all of that.
Well, that employee survey and what you do with it, the lights in the parking lot, that goes a long way. That they begin to understand that we're listening. But that has to follow through with the management team too. I mean, we can do a survey once a year and do a couple little things here and there, but the management team has to recognize that there's a greater level of communication that has to happen across all employees, not just those that are investors. So you got to get them buying into. If we're doing it from afar, it's not super valuable. The other thing I think is we have to be present. I like to have board meetings in their offices. There have been instances where we get pizza for the office and we all sit around. We'll oftentimes come in the night before a board meeting and we will have dinner. And it's not just with the narrow management team and the board, it's with 20 people. And it's a way to try to be a little more approachable and understand that, we're part of the team, while at the same time recognizing that they run the business.
Yeah. Having that genuine connection with the employees.
Yeah.
Doug, did you have
Do you start with the end in mind? Like if you buy a business that's, say, generating 15 million in revenue, you say, well, we'll sell it when it hits 150 or 200 or about. How do you?
That's a great question. So I think of it in a different way. I think of it in the end game is, we talk about this at every board meeting, is what do you want to be when you grow up? So we'll come up with it's a detailed list of, we want to build a stable, scalable platform for growth. And what does it mean to be a stable, scalable platform for growth? You got to have, accomplished management team with a good bench. You have to have really good metrics. You have to have a theme of continuous improvement. There's a couple of other things. One of them is you have to be the acquirer and the employer of choice in an industry. That's where I think about it as like, what do you want the headlines to be when you sell? And we talk about that at every board. How are we doing on where we want to go? And so I don't think of it as a number as much of it is a characteristic. And so if you can, and I see it, we go down the list and people are checking like, yeah, okay, we're that. We're not good here yet. We more work to do. And it's about 6 themes with a bunch of sub themes within them, all about being this stable, scalable platform for growth. And I've always kind of recognized that when you're checking a lot of the boxes and you're good to go, it's probably time for us to sell the business.
move forward? Yeah.
But it'll be one where everybody recognizes it. It's not just us saying it, it's the whole team.
Certainly. One final question, Robin.
When in the process during due diligence or when do you start to develop that roadmap or professionalization of that specific company? Exactly what they
We're starting to develop it ourselves initially and beginning to talk with the team about it. But that strategy session that happens post-close and that is with all the management team is where it really starts to come to the fore. I've always struggled with those that say that they've got it all done before closing, because you haven't, if you've done that, you haven't engaged the management team. So it's not, we want this to be their plan, not our plan that we're telling you to do. So I think it's really more about getting everybody aligned, and you can't do that before you close.
Wonderful. Well, thank you, everyone. Rob Hogan,